U.S. stocks dove deeper Tuesday as investors prepared for Fed Reserve officials to deliver another jumbo rate hike in their fight against inflation. The S&P 500 slid, the Dow Jones Industrial Average stumbled, and the Nasdaq Composite slumped. If you're looking for deals, this is a wonderful time. According to Bespoke Investment Group, 1/4 of all trading days so far this year have seen declines of 1% or more. The only other post-World War II years with a higher frequency of days with such losses were 1974, 2002, and 2008. It brings back good memories. In the meantime, the 10-year Treasury remains above 3.5%, its highest level since 2011, while the 2-year Treasury note is pacing toward 4%. Now, that's indicating recession to me. Now, no matter what investment you may be in, it seems no one has escaped the pain. The only winners will be those with cash, long-term plans, and courage. So let's take a look. We're now looking at a 20-year monthly chart on the Fidelity Nasdaq Composite Index ETF, and the symbol is ONEQ, and this is a pretty good proxy for the Nasdaq. And the reason we're looking at the Nasdaq is because the Nasdaq has felt the most pain. As you can see here, riding along the 50 EMA at this point, it bounced, came on up here to the 20 EMA and got reflected back, but it's still above that 50 EMA, and I'm going to bet that there's at least 50-50 probability that it stays above that 50 EMA. Now, this also depends upon what happens with the rate hikes and things of that sort, but for the most part, right now, I think it's going to be very difficult for the market to actually exceed on the downside below or much below the 50 EMA. It's going to hang around this level, in my humble opinion, at least from what I see now. Let's take a look at the oscillators. Volume tells you nothing. Here, the MAC, it does show that there's a big separation between the slow line there in red and the fast line here in black, and you know what that means? That means volatility, and we've certainly seen that in the past few weeks, even though I haven't been paying too much attention. Now, we still have plenty of time that we need to proceed before the healing can begin, but I think once we get into the histogram, you can see that things are actually trying to bottom and base here. Now, given it is so far below, the histogram so far below that zero line, all the way down here to -2, which is the worst reading it has in its 20 years, it is going to take a lot of time for this histogram to move on up toward that zero line. It's going to take perhaps months, but some of the deals that can be had at good prices are amongst us now. So if you have a plan to perhaps continue averaging in, that might be a good strategy. Moving down here into the price rate of change, you can see the attempt here and then the reflection on down. Big separation between the fast line there and the slow line here, well below zero. So this is not all that encouraging. However, the RSI is somewhat encouraging, even though it's at a 37.18 level, a relatively weak level. We do see that bottom here, and it's struggling to get further down. So we have some upward movement and I think improvement, a little bit of a divergence there. Into the stochastics, we're nearing that oversold territory below 20, and it looks somewhat comparable as it did back in 2008 and 2009. We haven't seen anything that deep since then, so we're pretty far down here, and I would imagine that this is the very initial stages of a bottoming and basing. Now, it could take months given the separation that we saw in the fast line and the slow line in the MAC, so be careful. But here also a bit of divergence in the Williams with that bottom hit here in earlier 2022 and some say positive improvement through here. We're still in that oversold territory. but we'll have to climb out, and we'll start to move out of that oversold territory and move on up. But then again, it is going to take time before we get up to that, say, midline or -50 line. That is going to take some time. So averaging in might be a great strategy. Moving back up, one more look at that price chart. And I think you can see, and take a look at the other indices, I think you can see that they want to ride along that 50 EMA. So that's a point to watch for here in the future, and watch that histogram improve. There's no hurry. There's deals out there, but again, there's no hurry. So keep stacking that cash and perhaps average in if that's your goal. And for today, that's ChewDog Charts. Thank you.